We've been doing these quarterly now for a couple of years. Larry, Bob, you've both been so helpful to us as small, medium, and large business people, operators. These have been very helpful, but I can't help but tell you that I think this quarter is more important than any before us in this couple of years that we've been doing this. And the headline here is, I'm confused. And Bob, you're expert in so many things, but especially in capital. And let's look at capital as a plasma of the economy and of business formation and growth and development. You've been active in so many ways. You've run money center banks, and now you run Atlas Merchant Capital. And you've been doing a lot of investing around things that used to be done by the banks and are now better done outside the banking system. You talked to us in the quarters gone by about the importance of regional banks to the whole business cycle, the whole business community here in the U.S. and elsewhere. But I see you just did a deal where you merged two middle market investment banking platforms in the UK, Panmure, which is a storied brand in the UK, and Liberum. Looks to me like you're anticipating that the markets are going to stay a little tough for middle market banking, particularly in the UK, particularly in Europe. That's what I read into that. But I see you've been active in the regionals. I see you've been forming other businesses. You have regional advisory firms like Cascadia. You have South Street, New York. You made a smart investment in a company called Marshberry that's in the works in the insurance space, DPL, which works in the annuity space. So you've been doing things that used to be done in the money center banks and are now better done outside. Bob, can you give us a sense of what's going on with capital? And I'll add one more addendum to my question. IPOs are few and far between. There have been, in the last year, very little, relatively speaking, in venture capital investing, very light private equity investing. You have the emergence of the new big asset management firms and a new emergence of private credit. What's going on in the capital formation world? Are businesses getting properly capitalized? All of this under the rainbow of record stock market performance. Bob, what's going on?
So, Jim, I think you're hitting it spot on in terms of the question people have. 2023 was probably one of the most challenging years for raising capital, IPOs, debt capital markets, private investment, private equity, really across the board. And I think every once in a while we get one of those wow moments. And I think if you look at the record in early January for capital markets issuance across the piece, as we tally these numbers, it is a wow. It is, I think, a function of people recognizing that rates have peaked. I think the demand for investing at these kinds of levels, 5% and above for investment grade debt, has been very, very strong. And I think the feeling, particularly after a year of challenging markets, then kind of the motto that every corporate and every person needing funds should have, which is that you fund when you can, not when you need to, means we have a very robust start to the year. And I think that's very, very different than it was a year ago. To your point, Jim, we're finding an amazing opportunity to find advisory platforms that serve middle market companies, whether it's Kepler Chevreau in Paris or Panmure Liberum now. Cascadia announced a deal last week. So we've announced two deals last week in a space where a year ago we were not seeing transactions like this. So
is that because the regionals have melted back? There's more opportunity there?
I think it's because the larger interconnected banks were never particularly good at covering middle market and family-owned businesses. Today, they don't even pay attention. The Morgan Stanleys and Goldman Sachses even are not paying attention. We do more business with Morgan Stanley Wealth than Morgan Stanley Wealth does with their own investment bank in middle market investing. And I think we're off to a great start. And I would call everyone on this call to go back a year when we came on. And the consensus coming out of Davos was 4% rates, that's where we are. And we have a recession coming. That was across the board. And then Larry Kantor came on and said, it's not 4%. They're going to be higher, longer. And he said then they're going to go over 5%. And he talked about, you're going to find this interesting, but there's a lot of strength in the economy. So I'm very, very anxious to shut up and hear from Larry Kantor as we begin 2024.
Well, we're about to do that. And Larry, I'm confused. I admit it. Bob's rosy. He's Bob-a-mist. Larry, we have record stock market levels yesterday. We have half as many public companies, 4,000, as we did in the 90s. We have a war in Europe. We have the Gaza situation. I now know what a Houthi is. I didn't know what a Houthi was a year ago. I didn't care what a Houthi was. I knew what a Hoya was, but I didn't know what a Houthi was. The political discourse is more fractured and strained than ever. Tensions with Russia, appropriately, are off the charts. China, I don't know. Iran is fermenting trouble throughout the Middle East. It seems to me, as a smaller business person, that we have two economies. Paycheck to paycheck people are struggling, although it's gotten better, and that's a direct result of oil at $70 a barrel. It's has such an immediate impact on our wallets. We had $2 trillion in government spending to bail us out of the COVID crisis. And Dr. Jeremy Siegel, your friend at the University of Pennsylvania, says inflation is caused by one thing: government overspending. They're printing of money, and $2 trillion was 13% of GDP. Wow, oh wow. Inflation Reduction Act, one of the great misnamings of all time, is spending more money. I know you like some good aspects of it. They have a couple of old guys running for president. We have non-government payrolls down for the last year. We have 630,000 people who have left the workforce. Bob just told us about capital formation and how it's changing and shifting. Larry, tell me how I should look at what's going on.
Well, I'm not a political expert. I mean, there's no question that geopolitical risk is higher than it's been probably in my lifetime. We have a war in Europe, and we have a war in the Middle East. And, given what's going on in Iran and so forth, it's scary. I don't think any of us, me for sure, can price that. We have to be aware of it, but we can't price it. I think, Jim, if you want to talk, we can talk about, this one thing we can't talk about economically is shipping rates and what's going on with the Houthis and so forth. I'll leave that for Q&A, I'm sure. Just a few things that I want to say in response to you. First of all, it wasn't 2 trillion, it was 5 trillion. So it was, fiscal stimulus was 5 trillion, which was 25% of GDP. And one of the big reasons why we didn't have a recession, and you remember we called that. The other one was this shortage in the labor market, which, when you don't have enough workers and there's all these job openings, you can get a reduction in demand for employment and still have job growth. So those are the two big things that actually cushioned the economy. The other thing I want to talk about is just recently you've seen all the consumer confidence indices move up. And I think part of it is that lags, which actually is happening. So inflation came down, peaked like over a year ago, is now running core inflation, I'll talk about it, 2%. And obviously, when inflation was 9%, prices went up a lot, and the level is still way higher than it was. But I think, as you said, Jim, especially gasoline prices, which are the most visible and important, have come way down. And I think consumer confidence is improving. And after all, the labor market is great. I mean, so let me talk about this. I mean, we advertised this session with a question: are rate cuts around the corner? So let me just answer that right up front. No, I hate to say it, but they're not.
And why is that, Larry?
Is that there's still some juice left here in the U.S. economy, in our opinion. So we've seen wild swings in the business cycle and financial markets, since COVID struck nearly 4 years ago. But that's largely behind us. And the focus now is how the economy and inflation are going to evolve and how the Fed's going to respond to it. I think that seems to be what's moving financial markets. Now, economic forecasters and the Fed are expecting continued low inflation, a very weak U.S. economy, and the markets are pricing in 125 to 150 basis points of Fed rate cuts this year, with 50 to 75 by June. So this combination of deep Fed rate cuts, low inflation, and an economy that barely grows, for us, doesn't really hold together. In particular, we think everyone's, again, underestimating the resilience of this U.S. economy, much as they did last year. I mean, if you remember, the economy, by the way, if the economy continues to exhibit solid growth, we think the Fed's going to proceed much more cautiously than markets are pricing. In other words, rates should be higher for longer. In the event, by the way, if the Fed does cut rates significantly in the first half of the year, the economy is going to accelerate. And this is going to risk all this progress we made on inflation. Then we'll really be in trouble. And the Fed will have
Larry,
to.
you've been a fan of Chairman Powell and the activities, steps he's taken in the last 18 months. You talked about how 3 years ago, the Fed probably saved the world financially by stepping in and being a buyer of everything in sight. But it seems to me that he is one of the least political Fed chairs we've seen. How do we play that? How do you factor that into your thinking about this year and the potential for rate cuts?
Yeah, I wouldn't call myself a fan of Powell or not a fan. I mean, as Bob and I both share this view, they basically have not done a good job in terms of getting ahead of the curve. They just made up for it. So in other words, they were way behind the inflation curve. I mean, I think it was pretty obvious, at least by November of 2021, that inflation was getting out of hand, and they kept saying it's temporary. And it took them until March of 2022 to start hiking rates. They were still plowing tons of liquidity into the markets. So they were late, and that by being late, they had to be much more aggressive more quickly. And even on the downside, it wasn't that long ago, just a few months, they were still having a very hawkish stance, even though core inflation had come down to 2%. So what I would say positively is once they realized they were behind the curve on inflation, they acted appropriately. Fed hiked rates faster than they did since Paul Volcker were at. When I used to be at the Fed, it's a long time ago, over 40 years ago, and they really responded appropriately. So, there's good and bad, and some of it's the Fed staff. I mean, Powell's not an economist, first one in a long time, and depends a lot on the staff. And they got it wrong, but they made up for it. So, if you remember, Bob we just talked about the overwhelming consensus a year ago that we were going into recession. And the Fed ended up hiking rates by still another 100 basis points after this time last year. And not only didn't the economy go into recession, it actually accelerated. I mean, if you look back at GDP growth, it actually was under 1% in 2022 with 9 months of Fed tightening. Last year, we'll see, we get fourth quarter, the first estimate, just in a couple of days of fourth quarter GDP. But we had a 5% third quarter. The year as a whole averaged 2.75%. In the second half, about 3.5%. So it's hard. The economy actually accelerated.
Not bad.
Here with everybody expecting these big rate cuts. If you look historically at business cycles, and I do a lot of that, the Fed usually starts cutting, when they change and start cutting rates, it's usually after the economy's been beaten up by recession, not after it's accelerated. So you got to ask yourself, what the hell is going on? Why is there this overwhelming consensus that the Fed's going to drop rates sharply? And the main reason, of course, is that core inflation has fallen to the Fed's 2% target. And it's been running there for about 6 months, which is impressive. We get the the next number this Friday, actually, on the Fed's preferred inflation measure. And it's likely to, again, be up like 0.2 month on month, which is 2.5. And, we're still going to get great inflation numbers. And after all, the surge in inflation was why the Fed started hiking rates in the first place. So, it's not surprising from that point of view. I'll get to inflation in a few minutes. The other reason is this consensus, and it's an overwhelming consensus, that the US economy is going to be really weak this year. So the Wall Street Journal does a survey of 71 economists. It got everybody on Wall Street. It's got industry groups. It's got some government agencies. The average is 1% growth. Bloomberg does a survey. The average there is 0.9%. There's with that 71, I think there were 2 or 3 that had growth over 2%. Now, the Fed, by the way, their consensus, if you look at FOMC, this participants, about 1.5. Now, this belief reflects the view that the economy can't keep growing like it has been with such a restrictive monetary policy. And after all, look, the economy always fell into recession when the Fed hikes rates that much and the curve inverts. It didn't happen. Forecasters initially pushed out their recession forecasts when the economic data kept beating expectations. And finally, after an acceleration in the second half of last year, they threw in the towel and instead said we're going to have a so-called soft landing with an extended period of minimal growth. So that's where we are now. Now, there's several reasons I want to get into this. I can't just say, well, I think the economy is going to hold up without explaining why that's the case. So there's a bunch of reasons. It's true that Fed policy rates are, somewhere on the restrictive side. Definitely, bank lending standards have tightened. Bank lending has slowed. Bob knows all about this, I'm sure, not a lot more than I do. So that's all true. But if you look at financial conditions, they've actually eased a lot. Bond yields have fallen close to 100 basis points over the past few months. The S&P's up over 17% just since late October. Both of those should help to boost economic activity. But there's a bunch of others. While monetary policy remains tight, everybody's focused on this. Fiscal policies become expansionary again. And I think, Bob, Jim, you were alluding to this. So the budget deficit for fiscal year 2023, fiscal year ended in September, was close to 8% of GDP. That's the highest since early 2022. The deficit for the fourth quarter, we've got those numbers, that's the first quarter of fiscal 24, was $90 billion higher, $90 billion than it was a year ago, despite really strong tax receipts. Federal spending, right, from a year earlier was up almost 12%. That's a big fiscal boost. Then you look at the consumer, right? Consumer, as we all know, is 2/3 of the economy. They're in very, very healthy shape, and I think they can continue spending. Now, we just got, a week ago, retail sales for December. They were surprisingly strong, and that already has pared back expectations for a Fed rate cut as soon as March. So before that number, there was over an 80% probability the Fed was going to cut rates by March. That probability sunk just under 50%. It's 47 or something. But more importantly, the labor market, I talked about it before, continues to create jobs at a healthy pace, and that creates income. I mean, job growth has slowed, no question about it, but the fourth quarter still averaged 165,000 jobs per month. And the unemployment rate is kept below 4%. If you do a survey of economists and they say, what's full employment? It's about where it is now. In other words, there's always going to be frictional unemployment, people moving, people graduating college, looking for a job, changing job. And we're still, after all that tightening, on the monetary side, we're still generating jobs in the
Larry, as an operator, I can tell you that the job market has returned more to normal. That is, 2 years
yes,
ago, we could not fill jobs at any price. So
right,
we had a big jump in our cost for entry-level hourly wages. That's not going to go backwards.
right,
And this year, we were able to fill every job, which had the benefit of not having us run overtime. So it
yes,
seems to be a much more normalized market now, from an operator's point of view.
right.
Did people return to the workforce? The 8 million who left during COVID, did enough of them return that it eased that temporary crisis?
Definitely. There's been a big increase in labor supply. It's stalled over the last few months, but the answer is yes, Jim. A lot of people, I mean, the labor supply, and it's been better balanced, but it's still not quite. And this is a good question, Jim, because yes, okay, so we averaged 165,000 a month. That's less than it was for the total year, which was something like 299, and way less. We were getting some gains of 500,000 a month. So but why do I think job growth is going to continue to be solid, not as strong as before? Because one of the things I look at is how many job openings are there and how many people are unemployed. Believe it or not, back in March 2022, there were 12 million job openings. That's a record by far. Now there's 8.8. Okay, so it's come down,
It's still
but
high.
that's still well above the number of people unemployed, which is about 6.3 million. And before COVID, job openings were 7 was considered normal. We're still close to 9. It's coming down. So that tells you that we're still going to get solid job growth. Also, remember this, with inflation having come down, wages are growing about 4% or a little more. Core inflation is now 3%, so is headline inflation. That's in other words, real wages are going up. When wages are growing faster than inflation, that helps the consumer, obviously. Then you look at household balance sheets. Okay. So one thing I look at, because before recessions, before real weakness, people get over their skis, either the business sector or the household sector. So I look at one thing I like. People look at debt to GDP. That makes no sense to me. I look at, because it depends what are interest rates, right? Debt service payments, so interest payments and so forth, as a percent of disposable income, are still below where they were pre-COVID and way below where you see them at cyclical peaks. So households in general are not overextended. And at the same time, this recent rise in stock prices, if you look at household net worth or household wealth, it's back up to record levels. So you put all this together, and this surprise kind of shocked the markets how strong retail sales were in December. The consumers got some life left. It's not going to last forever. None of these cycles ever do. But when I look at the consumer sector, I don't see why we still get strong spending for at least several more months. And by the way, the consumer is not the only sector that's doing well. I was looking at all these numbers. So investment spending and construction spending are a lot stronger than you might think. Now, it's been helped, Jim, by what you alluded to earlier, and that's the 2 trillion number is what the Biden administration has allocated to put money into factories and infrastructure. Okay, this is the first industrial policy we've had in decades. Now, that money, the 2 trillion, is supposed to be spent over many years, but they're starting to pump that in. So if you look at private non-residential investment spending, it's been running about 7% year on year. That's solid investment spending. Construction's been even stronger. So if you look at non-residential construction spending, it's up 19% year on year, and public construction's up 16%. These are
Wow.
strong numbers, and it's been sort of under the table. And it took me looking through all the GDP numbers. I was actually surprised how strong that stuff
Larry,
is.
you've told us in past calls that
Yeah,
we're at the very beginning of a very important 10-year cycle, which is a result of all of those things we talked about at the very beginning, and that
right.
is globalization. And the
Yeah,
consequence of told us of that is you see it with Gensler and the people at Intel building a massive fob in Ohio.
Yeah.
We're going to have a lot of companies say, I have to risk adjust my global sourcing. So it can't just be the lowest cost producing environment anymore. It has to be a risk adjusted determination as to where I put those plants, which means a lot more is going to come here in the next decade. What's the consequence of that, Larry?
Yeah, well, semiconductors, by the way, is a great example. I mean, as you know, we depend on Asia for those, and they're building capacity here. The only thing is, and this gets into the political side, which I don't claim to be any expert, and this may explain why presidents before, we've been way behind on infrastructure spending, because you don't see the full benefits for many years. It takes time to build this, the factories and, the production facilities and all that. And so, but it's happening. It's starting to happen. Clean energy, all that stuff. And now, just to continue my story, because
well, just look at Intel's factory in Ohio. There are 10,000 students. I'm guessing at a number. 10,000 students who would have gone to the coast to go to school to get that good engineering training, and now all of the universities in Ohio and the surrounding states have pooled their resources to adapt their programs to develop the tech talent that Intel's going to need in that facility in Ohio and all the supporting industries around it. That changes everything because now people in the middle of the country who have been taking it on the chin are going to have a lot more really well-paying jobs.
Right. I do want to address, Jim, just a second, because there's still weak spots. And, look, manufacturing and housing got clobbered when interest rates went up. And
they went through a recession, you told us.
But yeah, they did. Exactly. That was the recession. It just didn't spread because of the other things we were talking about, all the stimulus and the labor market shortage. But it's not, they don't seem likely to go down further, especially if interest rates start going down. In fact, housing, I think, is likely to perk up we've had a drop in mortgage rates of over 100 basis points. It's true that new home sales fell toward the end of the year in lagged response to the rise in mortgage rates. But if you look at single family housing starts, so the existing home market's sort of dead because people are sitting on lower mortgage rates and
they're not giving them up.
Right. So the inventory of unsold of existing homes for sales is very weak. But if you look at single family housing starts, which is the indicator of construction in single family residential housing, it's actually up 15% year on year. And
so, Larry, what about all those private equity firms who bought up those single family homes? Sounds to me like they're sitting on a home run.
I think so. Yeah, that's why prices keep going up, because it's such a dearth of inventory. So the housing again. Now, again, I'm thinking the Fed's going to hold off. We are, but we have had a drop in bond yields already. So let me talk about inflation a little bit, and then I can wrap it up. There's no question there's been great reason for optimism. I mean, there's the CPI. The Fed likes the PCE deflator. I said we're going to get one on Friday. It's down towards 2%. Now, however, I think it's not a slam dunk that it's going to stay that low. The big movement's been in goods, right? Goods prices versus services. Services have a bigger weight in the indices, but it's goods that are most cyclical. And you remember we had this surge in demand for goods during COVID when everybody was stuck at home and they weren't going out to restaurants, they weren't traveling. And then those goods prices. So if you look at why did inflation come down from like 9 to 2, we had the energy side for sure, but we also had declining goods prices. Okay.
Deflation in goods, while housing has still been the biggest cause of inflation.
Well, housing and services in general. I mean, everybody started traveling. Everybody said so. And why did that happen? Well, once people started re-engaging in all these services and going out to restaurants and gyms and bars and traveling, their demand for goods fell at the exact same time that all these supply bottlenecks disappeared because we were going back to normal and goods prices started declining. Now, There's other helps. I mean, the Chinese economy's been incredibly weak, and that's helped to lower commodity prices, as has a surge in US production of oil and natural gas. So all that has definitely helped. But it's going to be very difficult to get core inflation any lower, and there's a risk that it could begin to pick up. If you look at the service side, which is the bigger weight, that's been running at about 4%. It's been more than offset by this decline in goods prices. So if the economy holds up as we expect, the Fed's likely to proceed much more cautiously and resist cutting rates because they want to avoid reigniting inflation. So let me sum it up here. And then I'll say just a few words about markets, and then we can open it back up. But we think the economy is going to hold up for the next 6 months or so. And the Fed's either going to hold rates steady or maybe do 125 basis point cut, but we're talking about early summer. What's the market pricing in? The markets are currently pricing in a greater probability than 80% for 50 to 75 basis points just by June. And then, as I said before, 125 to 150 at the end of the year. So if the Fed's cautious as we expect and keeps rate at or close to current levels, the economy is likely to slow by year end. And part of it, Jim, is what you said. I mean, the labor market's normalizing. We will get steadily lower job growth. Those job openings are going to come down, and that creates less income growth. But still, this pricing of 125 to 175 basis points by year end seems excessive. So let me just.
So your summary then, Larry, is as investors, as business people, we should look out and say, yes, there's craziness all around us, but you have to look through all that craziness, risk adjusted, and you're saying it looks pretty good.
Yeah, right. Yeah, I think Curb is coming back actually in February, but no, you're right, Jim. So for the economy, and so if you look at, let me just say a few words about bonds and stocks. So now this big drop in bond yields was to a large extent, but also because everybody was expecting these Fed rate cuts. And so you're already seeing bond yields edge up. And I think if the economy keeps staying strong, and the Fed, they're in the quiet period now before the next FOMC meeting starts talking more hawkishly because the economy is doing better. I think you'll see bond yields continue to edge up a bit. I mean, they're in the low fours. They were up at 5 in October, fell below 4. Now they're in the low fours. They probably edge up. We've been saying 4 to 5% 10-year is in the new normal. On the stock market side,
it's also the old normal.
You mentioned, right, that's right. You've mentioned, Jim, that stocks have hit new records, and they have. But let's keep this in perspective. They're barely above where they were a year ago. Sorry, 2 years ago, at the beginning of 2022. They're barely above that. And that's despite much better performance in the economy than everybody expected. Now, if the economy continues to grow solidly, that augurs pretty well for profits. If you look at year-on-year corporate profit growth, it's actually started going up. And I think that continues. And I would add, because I haven't talked about China and Europe, the US is massively outperforming every developed country in the world and most developing countries. And that only increases the relative attraction of US markets. So to me,
it also helps, as you pointed out, Larry, that we're an energy producer and exporter, that we grow our own food here, that we have defensible borders because of 2 oceans. So we have a lot of geography and a lot of demographics in our favor there. But and that looks like it holds up for some time.
Yes, and that's why I would say on the stock market, I don't see us positioned for a sharp pullback anytime soon. Now, this is absent some unexpected negative event. And as you pointed out at the top, Jim, there's a load of that, probably more than we've seen in many, many years in terms of geopolitical risk. So I'll stop there, Jim. I'm sure you have some more questions or questions.
Well, we've covered a bunch of them, but I'd turn back to Bob for close in that, Bob, you've predicted what's going to happen in the financial markets quite accurately, and in particular, dissected for our community the banking sector, how it's evolved, how the money center banks have become coupon places, very reliable, steady, not going to take a lot of risk, and that the aggressive talent has moved away from those money center banks. Still very talented people there, but the new talent that would have gone there is now going to places like the companies you've been investing in. Sounds to me like you're expecting to do more of the same this year.
Very much more of the same, Jim. And I think, you know, the larger interconnected banks, particularly the best banks in the US, are going to continue to perform well. But I think an aspiration of mid-teens returns is the best they can do. There's some real benefits to higher rates. There's real benefits to now being paid interest on their reserves, which are huge.
Which is new.
But they are not centers of agility, mobility, innovation. And I think we're going to continue to see any business in financial services that can operate effectively away from a deposit-taking institution will do that, because there's far less capital required and far less regulatory intrusion. So continuation of the trend, and very excited about 2024.
Well, I think we've learned a lot from you guys again today. I don't know that I'm less confused because of just a core understanding of all these factors, but I have a sense from the two of you that I shouldn't be unduly concerned, and that from a business operator's point of view, continue to grow, keep your balance sheet in good shape. If you're a competitor of a company and you're of a category, and you need capital because you're not profitable and you don't have visibility of profitability, you're going to have a tough time raising capital, and that's going to create some opportunity. So overall, my glasses are a little bit rosier than they were at the beginning of the day. So thank you, guys. You give us great insights, great answers to questions we all have, and a great lens with which to judge our investment activities and our business operating activities. So thanks so much for another great quarterly insight. Thank you, Bob Diamond. Thank you, Larry Kantor.
Thank you, Jimmy.
Thank you.